We're here today to talk about a recent change in tax law that could have an impact on many of our clients, especially those in or nearing retirement. Welcome to the Fergasso Financial Advisors video blog. I'm Brandon Schwan, joined by my colleague Andrew Silver.
Earlier this year, the One Big Beautiful Bill Act was signed into law. This was a major piece of legislation with wide-ranging tax and spending changes. One provision is particularly relevant for Americans aged 65 and older, a new enhanced senior tax deduction.
And that's what we're going to focus on today. What this deduction is, who qualifies, and how it may influence your financial planning decisions.
Beginning in tax year 2025 and sunsetting in 2028, taxpayers aged 65 or older may qualify for an additional deduction of up to $6,000 per person. Married couples where both spouses are at least 65 can receive up to $12,000.
And that's on top of the standard deduction. To put that into perspective, for a single filer age 65 or older, the total deduction in 2025 could be up to $23,750. That's more than $7,000 higher than in 2024. For married couples filing jointly with both spouses age 65 or older, the deduction could rise to $46,700, which is more than $14,000 higher than last year.
And this chart shows the potential deduction amounts. These increases may not seem dramatic at first glance, but they can translate into thousands of dollars in tax savings depending on your income bracket.
So for many households, this will provide meaningful and extra flexibility in retirement.
Let's take a simple example. Imagine Mr. and Mrs. Smith, both 67, filing jointly. In 2024, their standard deduction was around $32,000. In 2025, with the Enhanced Senior Deduction, their total deduction jumps to $46,700. That's an increase of over $14,000.
If the Smiths are in the 22% tax bracket, that's an extra deduction that could lower their tax bill by more than $3,000. That's real money that stays in their pocket and can be used towards travel, healthcare, or just preserving more of their retirement savings.
But it's not unlimited. The deduction phases out at higher income levels.
Exactly. On this chart, you can see just that. For married filing jointly, the deduction begins to phase out once modified adjusted gross income exceeds $150,000 and disappears completely at $250,000. For all other filers, it phases out between $75,000 and $175,000. To make this real, let's look at a scenario we modeled. Scott and Monica, both over age 65. In 2024, their adjusted gross income was about $132,000. After applying the standard deduction, they owed roughly $12,000 in federal tax.
Now let's move to 2025 under the new law. With the Enhanced Senior Deduction, the deductions increased by over $12,000. That lowers their taxable income from around $99,000 to just about $85,000. As a result, their total tax bill drops to around $9,700.
That's a savings of more than $2,200 simply because of the new deduction. And notice what else happened. Their marginal bracket shifted down from 22% to 12%. So not only are they paying less tax overall, but the next dollar of income they earn is also taxed at a lower rate.
And that combination of lower taxable income and a lower marginal tax bracket can be really powerful. For retirees like Scott and Monica, this means more flexibility, maybe more cash for living expenses, or more room to plan for things like Roth conversions. And another important point, this deduction is temporary. As written today, it only applies to tax years 2025 through 2028. Unless Congress acts again, it goes away in 2029.
We've also heard some confusion about whether Social Security will stop being taxed because of this new deduction. The answer is no. Social Security is still taxed under the same rules as before. The Enhanced Senior Deduction is separate and doesn't change that. At the end of the day, these changes could lower tax bills for many filers 65 and older. But the amount of the benefit depends on your income level, your filing status, and the financial strategies you use.
And that's where working with your advisor is key. At Fergasso, we can help model how this deduction interacts with other planning decisions, like Roth conversions, capital gain harvesting, or retirement account withdrawals, so you can make informed choices. It's important to work with your tax professional on these planning decisions as well. This is part of our client experience at Fergasso. We welcome the opportunity to collaborate on your behalf with your accountant and attorney.
Thank you for joining us today. We'll continue to bring you timely updates on tax law changes and how they could affect your financial future.